What up, everybody? In this video, we'll talk about market structure. We'll talk about how to determine overall trend. We'll talk about how to determine counter trend, how to use market structure to determine your key levels, and then how to take entries off of those key levels and use a market structure to get in and out. Let's look at our chart here. This is the NASDAQ E-mini futures chart. We're looking at the weekly time frame currently. So here in the weekly, we can clearly see that the trend is bullish, meaning that we're creating higher highs and higher lows as price continues to rise. Now, there are a lot of swing points in a lot of areas here in which you can see the market has been moving. The market tends to move in waves. The market doesn't just move straight up. So you can see that we have the overall trend, right, which is the way that the market is actually going. And then within the overall trend, we also have counter trend. So a counter trend, for example, would be this area. Counter trend is simply when price action is moving in the opposite direction of the overall trend. So the way that you will determine trend is by looking at the lows and the highs. Now, if we look at this overall trend here, we can tell that here's a low, here's a higher low, here's another higher low, here's another higher low. And if we were to try to connect these, we would see that the market is going up, right? Cool. As those lows are getting higher, the highs are also getting high. Here's a high, here's another high, another high, another high, another high. So if you were to try to connect these as well, see that the market is trending upward, which means that it's a bullish trend. Now, these swing highs and swing lows create areas for us because they're like little footprints. They're telling us where price went, reacted to, and chose to reject from. Sometimes it happens once, sometimes it happens more than once, depending on what time frame you're looking at. So now, in this time frame, we see on the weekly, there's a rejection here, there's a rejection here, there's a rejection here. These are key levels, or you can use these as key levels when you would like to take a trade. So I like to chart on the 4 hour. After marking up my charts on the 4 hour, I like to go to the 1 hour to refine my key levels. So here we are on the 4 hour. And if I was to just mark up some key levels here that I'm seeing, I'm going to put some of the ones that are very, very obvious. There's a key level here in which price rejected off of. There's a key level here in which price rejected off of. So these are swings. There's another key level somewhere here that price rejected off of. And these would be great areas to take a trade or go in and look for your setups. Now, what I typically like to do is go down to the 1 hour. And on the 1 hour, I pretty much do the same thing with the key levels. The 1 hour, you can see key level here. Price came, rejected off of that area, did not close through. Another area is right here. Price came, touched this area, rejected off of it, and did not close above it. Be right here. Came down, reversed, touched this area. So here's us using market structure to determine our key levels. And if we're taking a trade, let's say we're looking to go bearish here and we want to take an entry from right here. As long as price does not close above this 1 hour supply zone, our entry should be valid. And this would be a great area to take shorts or a bearish trade from. Same as here, same as here. Earlier, we spoke about overall trends and counter trends. If we are taking sells from any of these areas, we're currently trading the counter trend because the overall trend is bullish. And we know that based on what we saw earlier on the weekly. It's important to know what the overall trend is and the counter trend is because people typically like to trade with the overall trend. So if you're a person who only wants to trade the overall trend, you would pretty much be waiting until this bearish run stops for you to then get in a trade so you can continue with the bullish run. Now, since we trade daily, right, we're in and out of trades within the same day, you can catch moves either way, but it's good to have your bias and it's good to determine your key levels so you can create your entry. Now, if I want to take a trade from this area here, let's say I wanted to wait until, I'm going to hop into replay. Let's say I wanted to wait until price came to this key level here. If price came to this level and did not close above this supply zone, that indicates to me that it's a valid supply zone. Let's just say I enter in, right? So I see a long wick. I entered in here. So I'm going to put my stop above this supply zone, and I'm shorting the market. My immediate target would be here. So this is the most recent swing low, right? As you can tell. And remember, we're in the 1 hour time frame right now. So this entire candle would have been taken an hour to create itself, but we're on the 1 hour time frame. So my immediate target, or my long-term target, I would say, would be here. That's about 280 points. So that's a very, very steep drop. I might be more comfortable taking a trade to a spot like here. And the reason for that is because there are two conflicting color candles here. So this is saying, all right, we had sellers in control right here, and then buyers took over, brought the candle all the way up from down here, and then continued to push. So there's some sort of area of a demand here as well as here. So if I was to just draw this out, and typically I wouldn't draw too many zones, but if I drew this out, there, and then potentially one here where the blue line is. If I drew these out, these would be areas that I want to watch just in case price starts to react there. And I just want to watch to make sure that I can safely exit if price does begin to reject. So if we drop down to the 5 minute and we entered here, right, in shorts, that was a very quick drop. But you can see here that we got to our 1 hour demand zone pretty quickly. And then after, it continued to drop to the next demand zone as well. So with this, I will be looking to take some exits or an exit in this zone right here. Typically, I like to do it at the beginning of the zone, or I'll do it where I see the market start to show long wicks, because that's indicating that there's opposite direction pressure in that area. So right here could have been a great area to take an exit and take some points off. So 293 points would have been great. And my stop was above the supply zone. So my stop was above the zone in which I entered. So if price came up to touch this, I would have been stopped out, but I'm giving it enough space to breathe and enough space to be able to come back, test this zone again if it needs to without wicking me out and then running. A lot of times the market likes to do a sweep. They like to go sweep liquidity, grab the orders that are sitting above or below specific zones. They like to go grab that market liquidity and then go run the other way. It doesn't happen every day, but it happens very often. So for that, if you're planning on taking an entry, you want to make sure that your stop loss is above the zone in which the liquidity is. Just want to make sure it's outside of that range for the liquidity. You don't know exactly where it's at, but you can kind of tell based upon market price, conditions, and the key levels. If this video was helpful for you, we take trades like this every single day in the Print Club. The Print Club is a free trading community where we help traders get better. If you're tired of guessing on the charts, the Print Club is where I break all of this down live. The exact arc setups, the levels, the entries. It's free to join. There's a free access link inside the description. Click it, get it, and I'll see you inside.